Good morning, Bitcoiners, and welcome back to your economic calendar, the news and analysis you need to start the week off right in Bitcoin. I'm Mauricio Di Bartolomeo, co-founder and chief strategy officer here in Ledn, and today is Tuesday, June 7th. We have a very special episode for you as always. In today's issue, we're going to talk about another look at US inflation, which we get this Friday, and what that could mean for Bitcoin and markets in general. And we're also going to talk about the panel that we're going to be participating in this week in Austin at Consensus, which is the ultimate Bitcoin use case. So it's going to be a great one. Grab your coffees. All right, so before we get going with today's analysis, as we mentioned, we are going to be in Austin at Consensus this week, participating in the panel that you see on the screen right now, and it'll be held on Friday at 4:45 p.m. this Friday. And the panel is the ultimate use case for Bitcoin, enabling activism, and it'll be basically myself, Alex Gladstein, Roya Mahoub from Afghanistan, and Sheila Warren will be moderating the panel. Very excited about this and to talk about Bitcoin and its use as a tool for human rights and financial freedom and independence. So very much looking forward to this. And if you guys are going to be in the conference, I welcome you to stop by and say hi after the panel. Moving on to our analysis and taking a look at Bitcoin, we see that last week Bitcoin broke its 9-week losing streak. Even though the candle was barely green, it was green nonetheless. Last week it closed higher by 1.56% at just below $30,000. It's given back essentially most of those gains so far today with a big drop this morning. And that's a lot to do with the news out of Target, which essentially forecasted that sales are going to be weaker than expected. And investors are sort of extrapolating this as potential future announcements from other retailers like Target. They say they're saying they have too much inventory and they're seeing sales slow down. So this might be a pickle that some other US retailers might find themselves in as the economy comes under pressure given the rising interest rates. We'll get into that in just a second. So markets in general have found some respite over the last week or so after more than 2 months of heavy selling. As we saw from the Bitcoin chart, essentially other asset charts look quite similar in the case of the S&P 500 and the NASDAQ. They've been under tremendous pressure over the last 2 months. And they're seeing some sort of breathing, some plateauing of the descent, at least for the last few days. Now, this might be just exhaustion from sellers, but we'll get into a few of the things that the market is showing us in a second. Now, part of what's been helping or part of what's been impacting the moves that we're seeing in the markets recently is the strengthening of the US dollar. So as we see, as the charts in many asset prices are essentially red across the board for the last 2 months, we see the exact opposite in the US dollar. The strength of the US dollar is coming on the back of rising interest rates for US Treasury bonds. As we know, as the interest rates on these bonds rise, the real return on the US dollar improves. The real return of the US dollar is the return of the bond yield minus inflation. So as the return of the bond yield ticks higher and inflation stays relatively the same or coming down, that improves the real return of the US dollar, which essentially makes the investment in those risk-free bonds more attractive to investors. Now, to put this in context, currently, the yield on the 10-year note of the United States, which is this chart here, is sitting right around 3%, 2.99%, right? While inflation is essentially still north of 8% in the United States, as per the last reading, which was April, and it came in at 8.2%. This makes the real return of the US dollars around negative 5% if you compare it to the yield on the 10-year note. Now, while a real return of negative 5% may not sound too enticing to some, considering the state of the market, the current uncertainty around commodity prices, and the ongoing geopolitical conflict, it can make a lot of sense to some investors to essentially look at that real return at negative 5 as something attractive relative to other asset prices that are, how other assets are performing. In fact, to sort of show this point, we want to compare the performance of the US dollar against other assets and show that the US dollar has in fact been the best performing asset year to date when you compare it to the S&P 500, gold, the NASDAQ, Bitcoin and the DeFi index. And we're going to show that in just a second. So here is the US dollar index, this chart here, commonly known as the Dixie to some. We're going to put this in a daily chart so that we can appreciate the chart a little bit better. And we're going to start at the beginning of 2022. And so on top of this chart, we're going to overlay Bitcoin. We're going to overlay the S&P 500, the NASDAQ, gold, and the DeFi index. So as you can see from the chart, the US dollar is essentially the best performing asset, up 6.6% since the beginning of the year, whereas gold is up only 2.77%, the S&P is down almost 15%, NASDAQ is down almost 23%, or 24% rather. Bitcoin's down essentially 36% and change since the start of the year, and the DeFi perpetual index is down 70% since the start of the year. So again, this just shows you, even though it has a negative real return, given where inflation is and where the bond yields are, the US dollar has still essentially kind of soaked the air out of the room over the course of 2022 so far. Now, speaking of bond rates, the US Federal Reserve is holding an interest rate decision meeting next week, where investors anticipate that they will announce another 50 basis points interest rate increase. As they do this, the real return of US bonds, or the US dollar, will continue to improve, provided that inflation stays static. And we get another read of inflation this Friday. As the real return of the US dollar improves, this could make it, or should make it, grind higher and even get stronger, which would put further pressure downwards on asset prices in the weeks to come. Remember, the US Federal Reserve may raise interest rates further next week, which should make the dollar stronger, therefore putting pressure in asset prices that are denominated in US dollars, like the ones we just went through. Now, given all of this and this sort of upcoming downward pressure from higher interest rates, there are signs that Bitcoin is starting to look attractive to some investors at the current levels, and that could help Bitcoin potentially get decoupled from equity prices. As we know, there's been a growing correlation between Bitcoin and the S&P 500 and other indices or financial assets. But we're going to show just now how that correlation has actually stopped getting stronger. It's actually coming down, the correlation between the S&P 500 and Bitcoin. And we're going to touch on that in just a second. One thing we wanted to mention in a recent podcast with Natalie Brunell, Lynn Alden, which runs Lynn Alden Investment Research, mentioned that at the current price, Bitcoin was seemingly in a value range. And as per Alden, this doesn't mean that the price can't go lower, but to investors with a 5 to 7 year investment time frame and the right risk tolerance, the current prices could be a good entry point, is what she highlights in her recent episode, in this recent episode with Natalie Brunell at Coin Stories. Similarly, we're starting to see some consistent information by looking at the funds flows into Bitcoin for the last 2 weeks. And for that, we want to share this chart here, which tracks the weekly crypto asset inflows into exchange traded funds. And so what we can see from here is that in the last 2 weeks, there have been inflows into crypto funds that trade in the stock markets. With the last week, literally last week, saw $100 million worth of inflows into funds. Most of the inflows, 125 million worth of them. Here's the details. As we can see here, there's been $125 million flowing into Bitcoin and $32.3 million flowing out of Ethereum. And so, as you can see, the inflows are mostly going into Bitcoin funds, and primarily that's led by the Purpose Bitcoin Fund here out of Canada, which has seen $113 million worth of inflows in the last week. Again, we just covered that in the same week, we saw $30 million exit Ethereum funds. So again, we're seeing big inflows into Bitcoin funds at the current prices. and that could be seen as a sign that investors or institutional investors are looking at some opportunities to essentially add to their Bitcoin positions at these levels. Now, similarly, as we just covered recently, we're seeing that the correlation on the 1 month between the S&P 500 and Bitcoin has essentially come down dramatically. Where a few weeks ago it was north of 80%, the 1 month correlation. As of yesterday, it was at 43%. This morning, it's actually further lower at 25.3%. So this is actually a healthy sign to see that Bitcoin is essentially starting to trade more independently from the S&P 500 and other equity indices. Now, all of these are encouraging signs for Bitcoin, even as the current economic environment remains uncertain for the near term. We're going to touch now on the upcoming inflation report in the United States this week and what that could mean for Bitcoin and other assets. And as always, we leave you with what's ahead for the week. Late last night, Senator Cynthia Lumens introduced a crypto or a bill to regulate the crypto industry in the United States Congress. We are going to be digesting or reviewing that proposed legislation and putting together a summary and a blog essentially around this proposed legislation. And that will probably be making headlines around the next week or so, given the importance of such a bill. And so that is something that will continue to make headlines. And we are going to essentially put up a blog post outlining essentially the bill itself and our thoughts on it as well. In addition to that, we have a Federal Reserve meeting next week on an interest rate decision, and the Federal Reserve is squarely focused on getting inflation under control. That makes this Friday's inflation data report for the month of May in the United States a very important report that will likely get the spotlight in this week ahead. Inflation seems to have peaked so far in March at 8.5%. April's inflation came in at 8.3%, and analysts and the Fed expect May inflation to come in at 8.2%, which would show progression or a step in the right direction. If this is the case, look for markets to cheer in relief. And while May's inflation data alone won't be enough to change the Fed's plans to raise rates next week, it signals a step in the right direction based on their stated outcomes, which is to get inflation under control. With lower inflation, in the way the Fed wants to make it happen, will also come higher unemployment because they're just basically removing disposable income from the pockets of people and corporations. Now, this may not seem like a problem just yet, this unemployment issue. However, cracks could start to appear in the labor market anytime now. We would only need to pick up the newspaper to see essentially recent layoff announcements from several large companies. And this is something that will likely not, this is a trend that will likely continue into the near future. And this could cause to start to see essentially some cracks in the labor market. We also get a look at initial and continuing jobless claims in the US this week on Thursday. So that gets us into the quick summary of the data that we can expect this week. As we mentioned, Thursday at 8:30 a.m., we get jobs market data in the US with initial and continuing claims. And on Friday, we get the sort of the main event of economic data, which is US core inflation for the month of May and the consumer price index for the month of May in the United States. So with that, we've reached the end of today's show. If you enjoyed the show, if you liked it, if you learned something, I welcome you to thumbs up, like it, subscribe to the channel, share it with your friends. If you don't yet have a Ledn account, I welcome you to check out Ledn.io and learn how you can start earning the best rates for your Bitcoin and USDC. And we also have the best rates for dollar loans backed by your Bitcoin if you need liquidity and don't want to sell. And our most recent product, the Bitcoin Mortgage, lets you purchase a house as big as your stack. Thank you, everybody. Take care and see you next week.